All right, Wes, what do some of these mortgage terms mean? Like some of these acronyms or some of these abbreviations, initials. Tell me a little bit more about this mortgage jargon. All right, so let's talk about some of these mortgage terms that you will hear during the home financing process. And sometimes with us using these terms day in, day out, we throw them around pretty easy. We all understand what they mean, but sometimes we forget when we might say it to you and not realize it. We always try to do a good job of helping you understand exactly what it is we're talking about. But sometimes we'll throw out a random mortgage term and forget that, hey, you might not know what it means. So let's talk about a few of them. One, let's talk about LTV. LTV is an abbreviation that stands for loan to value. And what that breaks down to is what percentage of the loan makes up the value of the home. Per example, if we're doing a loan for $80,000 and your home appraised for $100,000, your loan to value is 80%. So when you hear your mortgage professional talk about loan to value, that's exactly how that's calculated out. Your loan compared to your home's value in a ratio form. The second most common ratio that we talk about is your debt to income ratio. In the mortgage industry, there's two parts of the debt to income ratio. There's your front side DTI, it's an abbreviation. There's your front side DTI and your back side DTI. So let me help you understand exactly what that is. Your front side DTI is what debt to income ratio is. Before I get into that, what debt to income ratio is how much comes in, income, how much goes out, debt in a ratio form. So your front side DTI is just your mortgage debt. So how much income comes in and how much of that income goes out in mortgage debt. So like that is just based off of whatever that mortgage payment is that we're calculating for you makes up your front side DTI. Our loan amount is your front side DTI. Now, what is your backside DTI? Your backside DTI is how much income comes in compared to how much income goes out for all of your credit debts that we see. That's including your mortgage, your credit card, your car payments, anything else that's reporting to credit, child support, alimony, all that stuff's calculated in there. Any other crazy debt that we have to report during the loan process, all that is calculated in the backside DTI. What ratios do we have to operate in? We have programs that'll go into the low 40%. We have some programs that'll even go as high as close to 60% on the backside DTI. Every program has its own ratio guidelines. It's way too much to cover in this short video, but when we are having the conversations with you about how to qualify for these loans, we're going to take time to help you understand what that DTI is. HOI is your homeowner's insurance. If that's another term you'll hear, somebody might say, what's your HOI? Who's your HOI? HOI stands for homeowner's insurance, and that's like the insurance to protect the home that you actually set up with your insurance agent. So that's what HOI is. If you hear HOA, that's homeowners association. And maybe at this point your realtor would have let you know if a property you're looking at does have an HOA. Not all properties do have HOAs, but if you hear us talk about HOAs, that stands for homeowners association. You might hear a term MI or PMI, and a lot of people see that as a bad word, but what PMI and MI stands for is mortgage insurance or private mortgage insurance. And a lot of people don't truly understand what that is anyway. So let me take a second just to kind of share with you what it does. Mortgage insurance protects the investor in case of default of the loan. Back way before some of these programs were available, it used to, rule of thumb was you had to do like a 20% down payment in order to do financing on a house. So some of these government regulations came in place and opened the door to programs where you can do lesser down payment. But when you do lesser down payment, the loss risk is higher. And I'll paint that example for you in a second. But that's where mortgage insurance came in play. So mortgage insurance protects the banks and investors in case of default on the home. Let me give you an example of how that works. So let's say I do a 100% financing USDA loan for you. Actually, let's go with an FHA loan. Let's work with something with a little bit meat on the bones. So let's say we do an FHA loan with a 3.5% down payment. We're going to work off of a $100,000 price range to work just off of some even numbers. So a $100,000 loan with a 3.5% down payment, we financed $97,500 for you to buy that home. And that's not including any costs that you might have worked in, but let's just work off of even numbers here. Mortgage insurance is in place on that loan, especially an FHA loan, for the length of the loan, and conventional expires after you develop 80% or 20% equity in your home. You can get rid of the mortgage insurance on the conventional, but FHA is one of the ones where it actually sticks with you until you refinance it off. But so that $97,500 we lent on that house, let's say you're in there a year and it gets damaged, destroyed, broken, the value of the home decreases and you default on that payment. We lent you $97,500, and if that house at that point only appraises for $80,000, that's what mortgage insurance does. It protects the investor for the difference of what the home's worth compared to what's owed on it. So that's a little bit of mortgage insurance. If you want to have a more in-depth conversation on that, I encourage you to reach out to us because it can get a little confusing, but that's just a very vague example of what mortgage insurance is. So that's a little bit of some of the terms and the verbiage that gets thrown around. That's some of the common ones I can just think of that I think you would want to know about. But if you have more questions, or if you hear something dropped and you don't understand what that is, reach out to your mortgage advisor. We are here to help you understand. With that, this is Wes of the Wyrick Mortgage Group. Thank you for taking time to watch this module of Mortgage University, and keep watching. Thank you.